Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings in the second quarter of fiscal year 2023, and that stock is Microsoft. And we can see that over the last year, this stock is down around 11%, while the rest of the market is down around 6%, so they're underperforming the market at the moment. But over the 5-year chart, they're completely dominating. The rest of the market is up around 50%, while Microsoft is up almost 200%. So definitely doing way better over the 5-year chart. And so in this video, I'm just going to look into some of the recent news that came out surrounding Microsoft, look at their financial statements to get a better understanding of the fundamental financial health of the company. And lastly, I'm going to figure out the intrinsic value of the company, as well as compare them to companies in their industry, and then compare them to the companies we analyzed in the videos prior to this one. And so right here, right off the bat, we can see in this article, they point out that a new AI war has begun, and Microsoft is basically announcing a Chat GPT integration with Binge and Edge. And we can see if we scroll down here that they point out that Microsoft is basically going to implement new technology into their search engine and web browser. And Nadella pointed out that the race starts today and he intends to move quickly to get an edge over his competitors. And so right here in the first two paragraphs in particular right here, we can see they essentially point out that Nadella and OpenAI CEO Sam Altman basically are teaming up to set up Bing on a new language model that's way more powerful than Chat GPT, which is going to create a faster and more capable search engine. And Satya points out that this is a direct challenge to Google, which currently dominates the search engine market, and that the AI integrations could potentially result in a major shift away from Google and towards Bing, which currently only captures around 9% of the search engine market. And so ideally, this new integration with ChatGPT and OpenAI is going to give Bing that competitive edge and that head start in the AI race that's going to potentially allow them to gain some market share away from Google and expand their market and their competitive edge ahead of some of the other big tech companies that they're competing against. And so right here we can see this is their income statement comparing the second quarter results for fiscal year 2023 from 2022 and 2021. These are the months ended December 2022 and 2021. We can see during that time period, total revenue increased from 51.7 billion to 52.7 billion. So that's an increase of around 2% year over year. And of this revenue, around $27.1 billion came from their cloud revenue, and that was up a whopping 22% year over year. So their cloud revenue sector is definitely one of the leading segments of their revenue. If I scroll down here, we can see that net income is unfortunately down around 12% year over year from 18.7 billion to $16.4 billion. And so if I go to page 5 right here, we can see their balance sheet, and we can see total assets basically stayed around the same at around $364 billion. And we can also see that total stockholders' equity increased pretty substantially from $166 to $183 billion, with retained earnings increasing from $84 billion to almost $100 billion. So that's definitely a lot of money that they have to distribute to shareholders and repurchase shares of common stock and reinvest into the company. And then lastly, right here, we can see their cash flow statement comparing the 3 months ended December 2022 to 2021. And we can also see net cash from operations have decreased from $14.4 billion to $11.1 billion. And then in terms of their financing activities, we can see they've repurchased around $5.4 billion worth of common stock and paid out around $5 billion worth of cash dividends. So that's about $10 billion returned back to shareholders for this quarter. So that is definitely not too shabby for Microsoft in their second quarter results for fiscal year 2023. And so now we can see the discounted cash flow model for Microsoft that I've put together here. Yahoo Finance is estimating the company is going to grow at around 11% compounded annually for the next 5 years. They had around $65 billion worth of free cash flow in their most recent full year, around a $21 billion net cash position after subtracting their debt, and they have a little over 7 billion shares outstanding, which puts their intrinsic value per share at around $148 per share, which means that at the moment, based on these growth rates, they are not currently trading below intrinsic value per share, since they are currently trading at around $258 per share, but their intrinsic value is only around $148 per share. And so on the right-hand side here, I did a competitor analysis comparing them to some of the other big tech companies they're competing against in their industry, specifically Google and Apple. We can see that in comparison to Google and Apple, Microsoft has a higher gross profit margin, net profit margin, but they have a lower return on assets in comparison to Apple. They also have the highest PE ratio at around 29 times earnings, and they also pay out the highest dividend at around $2.48 per share. So based on this competitor analysis, it would look like from a profitability standpoint, Microsoft definitely has the competitive edge. They have the pricing power ahead of Apple. But in terms of PE ratio, they're trading at what looks to be the most expensive price relative to earnings ahead of Google and Apple. Google looks to be trading at the cheapest price relative to their earnings per share. And then lastly, on the right-hand side here, I compared Microsoft to some of the other companies we've covered in our recent videos. We can see that in terms of share price compared to intrinsic value, Microsoft is currently trading at around 174% of their intrinsic value, so 1.74 times intrinsic value, given that their intrinsic value per share is $148 and their share price is $258 per share. So they're not trading below intrinsic value per share. So far, the only company on this list that's trading below intrinsic value was Albertsons. They're trading at around 0.45 times their intrinsic value. In terms of growth rate, we can see Microsoft comes right around in the middle at around an 11% growth rate. Netflix still had the highest growth rate at around 16%. That was projected for the next 5 years. In terms of profitability, Adobe still holds the #1 spot for gross profitability at around almost 90%, with Microsoft coming in a close second at 68%, taking the second place spot in gross profitability. We can see that in terms of net profitability, Microsoft has overtaken Adobe and they've taken the #1 spot with 36% net profitability ahead of the other 5 companies that we've covered in our last 5 videos. And lastly, in terms of stock performance over the last 5 years, we can see that Microsoft has performed the best in comparison to Adobe, Nike, Accenture, Netflix, and Albertsons. They had performance of almost 200% growth in their stock performance over the last 5 years, pretty much doubling Adobe's stock performance of 96% over the last 5 years. So it looks like Microsoft is doing really well in terms of getting return back to their shareholders and in terms of profitability. And then in terms of share price to intrinsic value and growth rate, they're around middle of the pack right now. So they're not doing too bad, but they're also not doing too good relative to the other companies we've looked at in that regard. In terms of competitor analysis in their specific industry compared to Google and Apple, they have great profitability still, and they are paying the highest dividend. But in terms of intrinsic value per share, using a discounted cash flow model, they are currently not trading below their intrinsic value per share based on these growth rates of around 11 to 5% over the next decade or so. So based on that, it doesn't necessarily mean that Microsoft is a bad investment at the current share price because they're trading below intrinsic value. Obviously, it depends on the parameters that you're using when you're valuing a stock like this. Let me know in the comments section down below what you guys think about Microsoft as a buy right now. Is it a buy or a sell? And give me your reasons. I'm not too sure what to make of it at the moment, so I'd definitely love to talk about it. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.